Hello, dear learners, and in this session, we are going to explore the concept of the global economic environment and policy and its significance in shaping both national and international economies. The topic is foundational to understanding how fiscal, monetary, and structural policies influence growth, stability, and employment across the globe. Let's imagine if the Indian government imposes higher tariffs on imported electronics, what might happen? Prices of imported gadgets would go up locally, pushing consumers to buy domestic alternatives. But this decision also impacts exporting countries like China, potentially leading to trade tensions. Over the next few slides, we will dive deeper into specific components of global economic policy. By the end of this session, you will be able to explain the foundational concepts of economic policy, list the components of economic environment, and examine the significance of economic environment and the factors influencing it. Let's begin with the basics. Economic policy refers to the strategies and decisions made by governments to regulate their economies. The primary goals include ensuring full employment, maintaining low inflation, and achieving sustainable growth. These objectives aim to foster a stable economic environment where businesses can thrive and citizens enjoy improved living standards. For instance, during economic recessions, governments may use fiscal policies such as increased public spending to stimulate growth. Similarly, monetary policies like adjusting interest rates are used to control inflation and encourage investments. Together, these measures create a balance that drives long term development and stability. Understanding these mechanisms is really important for comprehending how policies affect businesses and households alike. In today's globalized world, economic policies transcend borders. What happens in one country often impacts others. A striking example is the 2008 financial crisis, which began in the US housing market but quickly had its impact across the globe. This crisis highlighted the need for coordinated international responses to stabilize economies. Organizations like the International Monetary Fund, IMF, the World Bank, and the Organization for Economic Cooperation and Development, OECD, played a critical role here. They provide financial assistance, technical expertise, and a platform for collaboration amongst nations. Their efforts ensure that economies remain resilient in the face of global challenges. For businesses, understanding this interconnectedness is vital as international trade and investments are directly influenced by such policies. Sustainable development is no longer optional. Over the years, it has become a necessity. Global economic policies are increasingly focused on addressing climate change and promoting environmental sustainability. For example, governments worldwide are offering incentives for businesses to adopt green technologies such as renewable energy solutions and carbon capture mechanisms. Green technologies refer to products, services, and processes that use natural resources efficiently, help reduce the environmental impact, and promote sustainability. These technologies create new industries, thereby offering millions of jobs globally. Carbon reduction incentives are measures taken by governments and businesses to reduce carbon emissions and encourage environmentally friendly practices. These initiatives not only reduce environmental harm but also open up new opportunities for innovation and economic growth. Now, let's understand what is economic environment. The economic environment encompasses all external factors that influence economic activities and decisions. These factors include employment levels, inflation rates, income distribution, and more. In simple words, all external economic factors that influence the final decisions and actions of firms, consumers, and the government are collectively referred to as the economic environment. It covers everything from employment levels and income distribution to interest rates and even inflation rates. By analyzing the economic environment, stakeholders can anticipate changes and adapt proactively, ensuring resilience in an ever evolving global landscape. Now that we have an understanding of what economic environment is, let us discuss the key components of economic environment. These components are essential for informed decision making. It includes government policies, market conditions, indicators, and global trends. Let's continue with the components of economic environment. First component is government policies. Government policies form the backbone of the economic environment. Fiscal policies such as government spending and taxation directly affect consumer behavior and business operations. For example, tax cuts can increase disposable income, leading to higher consumer spending, while public investment in infrastructure can create new business opportunities. Monetary policies, on the other hand, control money supply and interest rates. Lower interest rates encourage borrowings and investments, stimulating economic growth. Businesses and households must closely monitor these policies to make informed decisions. Moving on, the next component of economic policies is market conditions. To understand any economy or market, it's crucial to analyze its market conditions. But what does this term actually mean? It refers to the factors that influence how goods and services are bought, sold, and priced in a given market. Firstly, price trends. Price trends tell us how prices for goods and services are changing over time. For example, rising prices might indicate inflation, while falling prices might suggest deflation or increased competition. Secondly, competition levels. Competition levels measure how many businesses are vying for customers in a given market. High competition generally benefits consumers through lower prices and better quality products. But when competition is low, monopolies can emerge, leading to higher prices. Supply and demand dynamics. Supply and demand are the backbone of market conditions. When supply exceeds demand, prices tend to drop. When demand outpaces supply, prices rise. Think about limited edition products or seasonal goods. These are the perfect examples where supply and demand play a major role. Let us now discuss the economic indicators. Economic indicators are essential for assessing the health of an economy. GDP growth rates reflect the overall economic output and is a key measure of economic performance. Unemployment rates indicate the availability of jobs and the strength of the labor market. High unemployment often signals economic distress, while low unemployment suggests stability and growth. Inflation measures the rate at which prices for goods and services rise, affecting purchasing power. Consumer confidence, on the other hand, reveals public optimism about the economy, influencing spending and investment behaviors. These indicators guide policymakers and businesses in making informed decisions. Next, we have global economic trends. Global economic trends shape the broader context in which businesses operate. International trade policies such as tariffs and free trade agreements affect market access and competitiveness. Currency exchange rates influence the cost of exports and imports, directly impacting businesses involved in international trade. Additionally, the economic performance of major players like the United States, China, and the European Union creates ripple effects across the globe. For instance, a slowdown in China's economy can affect global supply chains and commodity prices. Businesses must stay attuned to these trends to adapt their strategies and seize opportunities in the global market. Now that we have an understanding of what the economic environment is, let us discuss its importance. All external economic factors that have an impact on a company's activities are included in the economic environment of business. Making wise choices about public policy, investments, and corporate strategy requires an understanding of the economic climate. The macro and micro elements that affect the economy are all included in the economic environment. Understanding the economic climate is crucial for making informed decisions regarding public policy, investments, and corporate strategies as it affects both macroeconomic and microeconomic conditions. The state of the economy plays a vital role in determining the success or failure of a business, with favorable economic conditions fostering growth and unfavorable conditions posing challenges. Economic trends such as fiscal policies and trade regulations shape business operations by either limiting or creating opportunities. Now, let us have a look at the important factors that influence economic environment of business. First is inflation. Inflation is the gradual rise in prices for goods and services. Increased inflation lowers people's purchasing power and devalues currency. Second, interest rate. Interest rate is the cost of borrowing money. Next factor is unemployment. The number of people actively looking for work but not being able to find it is known as unemployment, and it can put pressure on any of the economy. Fourth is GDP. GDP is the short for gross domestic product. It is the entire value of all products and services generated within an economy during a certain time period. And the last one is the consumer behavior. Here, consumer behavior tends to the confidence in consumer that influence their spending patterns. While low confidence can cause economic slowdowns, high confidence tends to boost spending. Inflation, the gradual rise in prices of goods and services, has wide ranging implications. While moderate inflation is a sign of a growing economy, excessive inflation can erode purchasing power, reducing the value of money. For businesses, inflation increases costs, potentially affecting profitability and pricing strategies. Policymakers often use monetary tools like interest rate adjustments to control inflation and maintain economic stability. Understanding inflation is essential for businesses and consumers alike as it influences spending, saving, and investment decisions. Interest rate is the cost of borrowing money, usually expressed as a percentage of the amount borrowed over a period of time, such as a year. It is the compensation paid by the borrower to the lender for the use of their money. Interest rates play an important role in shaping the economic environment, acting as both a regulator of economic activity and a signal to markets. When interest rates are high, borrowing becomes more expensive, discouraging both consumer spending and business investments. This can slow economic growth but is often used as a tool to control inflation. Conversely, low interest rates make borrowing cheaper, encouraging investments in infrastructure, businesses, and personal expenditures such as housing or education. For example, during economic downturns, central banks often lower interest rates to stimulate economic activity. Businesses and households must closely monitor interest rate trends to make informed financial decisions, such as the viability of loans or timing for investments. Understanding the ripple effects of interest rate changes help stakeholders align their strategies with the broader economic climate. Unemployment refers to the percentage of the labor force that is actively seeking work but unable to find employment. It is an important indicator of economic health. High unemployment levels strain the economy by reducing consumer spending, lowering tax revenues, and increasing government expenditure on welfare programs. Moreover, the social impact is significant, leading to skill degradation, mental health issues, and social unrest. Governments address unemployment through policies such as job creation programs, vocational training, and incentivizing businesses to hire more employees. For instance, subsidies for industries that employ a high number of workers can encourage hiring. Understanding unemployment trends allows policymakers and businesses to identify potential challenges and adapt strategies to mitigate its effects. GDP, or Gross Domestic Product, measures the total economic output of a nation, essentially, the value of all goods and services produced within a specific time frame. It serves as a comprehensive indicator of economic health. For example, consistent GDP growth suggests a robust and expanding economy, while stagnation or decline signals potential problems such as recession. Policymakers rely on GDP data to formulate fiscal and monetary policies aimed at fostering growth. Businesses also use GDP trends to forecast market demand and plan investments. However, it's important to note that GDP doesn't capture informal economic activities or environmental costs, leading to ongoing debates about alternative measures of progress such as gross national happiness or sustainable development goals SDGs. Consumer behavior is a driving force behind economic growth as spending accounts for a significant portion of GDP in most economies. Factors such as consumer confidence, income levels, and market trends heavily influence spending habits. For example, when confidence is high, people are more likely to make large purchases, fueling demand and encouraging businesses to invest and expand. Conversely, economic uncertainty often leads to reduced spending and increased saving. Understanding this dynamics is crucial for businesses to develop marketing strategies and product offerings that align with consumer needs. Also, policymakers track consumer behavior to gauge the effectiveness of economic measures such as stimulus packages designed to boost spending. Analyzing consumer trends provides valuable insights into the health of both individual markets and the broader economy. To summarize, in this session, we have learned and discussed about the foundational concepts of economic policy, including its definition, key goals, and role in fostering employment, controlling inflation, and also about ensuring sustainable economic growth. Learned about the economic environment and the components that shape the economic environment and evaluated the significance of key factors influencing the economic environment, including GDP, inflation, unemployment, and consumer behavior. With this, we come to the end of the session. Thank you and happy learning.